You're in the Business Insurance Zone with me, Steve Savant, national insurance columnist and financial color commentator. This week on The Biz, the Life Insurance Income Series, our tribute to Life Insurance Awareness Month. And on today's show, the 4 life insurance options.
When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.
Well, welcome everyone. I'm Steve Savant, host of the Business Insurance Zone, and I'm broadcasting live to a nationwide audience of financial advisors right here in Fountain Hills, Arizona, home of America's largest fountain, and co-hosting with me today and all this week, Eric Palmer. Eric, we're talking about life insurance in our series and our tribute to Life Insurance Month.
Right.
And when we're talking about life insurance income, we're talking about income that is really tax advantaged. And tomorrow's show, we're going to get into the tax issues, and there are a lot. But today I want to talk about the 4 chassis that you can have. Now, in the first segment, we're going to talk about par whole life, kind of the forgotten guy here on that,
Right,
the forgotten
right.
product, and we're going to talk about current assumption UL. Both of these chassis are interest oriented.
Right.
They have interest rate issues. That's what they're doing. In the next segment, we'll talk about indexing. Well, that's indices. And we're talking about VO. Well, that's sub-accounts
Right.
into the equity market. But when we're talking about these 2 products, they're really interest oriented or government. We're buying a lot of government debentures.
Absolutely, and I think it's really important to note here that, and the reason we're talking about these other products is you hear us, especially as of late, talk quite a bit about index universal life insurance, and we don't want to ignore the fact that the other chassis that are available out there, whether it's variable, whole life, or as you mentioned, current assumption life insurance, they're all good for providing a good alternative to some of these other traditional retirement plans that are out there. We just happen to talk a lot about index ULs because they're really a hot product and truly do have some extra advantages to them. But don't forget about whole life and current assumption policies, because on the conservative side of things, they're very strong. Whole life, although it has a little bit of a cost issue that's a little bit higher than some others, there's some stability in those dividends, and there's stability in the companies that are really providing some of the best whole lives out there today.
Well, as you know, when I first came into this market, and that was back in the mid-'80s, boy, I tell you what, current assumption UL was double-digit interest crediting rate. Of course, the problem was it was very expensive and clunky. The internal costs were really a lot.
Right.
They've really honed this thing down. And so if you're feeling, hey, I really need to stay in something much more conservative, I need to do an interest rate driven product, that would be a good idea. But I want to talk a little bit about whole life, and here's why. Interesting to note, we always show a 20 and 30 year look back on indexing.
Right.
A lot of the carriers publish it. We just republish it in the illustration. Okay. I've noticed that in the last 20 to 30 year look back on dividends, all the big players in that market of whole life, par whole life, none of those carriers did not have a non-dividend year. They always paid a dividend.
Right.
And the better the carrier, the bigger blue chips also pretty much came very close to what they thought it was going to be.
Right.
And a lot of them, some of these actually did better than we thought. So think about this. When I look at all the S&P for the last 20 or 30 years, there's been market losses. I mean, the last decade we had 4,
Right.
2001, 2, and 3, and 2008, we had 4 non-crediting years if you were in indexing.
Right.
When you think about whole life, they've never had that. There's always been a dividend paying issue. Now, that being said, it really looks great against 10-year treasuries, 1-year treasury notes. I mean, when you look at it, this is really something to say, hey, I like comfort about this. When we talk about how this works, though, think about it. To make it work and be competitive with indexing, you have to use 2/3 of the premium has to be in paid-up edition riders.
Right.
And you have to use a term insurance to get into the MEC or underneath that death benefit.
Right.
So you can make it work. And right now, just to give you a comparison, so kind of almost a transition to our next segment,
Right.
when you think about it, whole life is really a conservative instrument. The negative about it, I just can't unbundle it. I don't know what the costs are. They're kind of encrypted into the contract, and a dividend is only a return of unused premium and whatever their bond portfolio has been pulling out.
Right. So your arbitrage, you make a good point. So your arbitrage between your rate and your costs are a little bit different. It's not as significant as you would find in, say, some of the other product chassis that we talk about. So there's a little bit of cloudiness there in terms of what is my actual all-in cost of the contract versus what I'm getting in return on that dividend. And you made a great point, paid up additions and term blending. You have to remember with whole life, you can't just dump a bunch of cash in and let things go for good, because there's not enough arbitrage, as I mentioned there, between the dividend rate and the cost of insurance. So blending in those paid up additions, and also looking at term blends are how you're really flooding these contracts with cash. And don't worry about a term blend because, again, we're not talking necessarily about an indemnity sale. We're really focusing in on the cash accumulation and the potential to take some cash out tax-free, so it becomes less of an issue if we're blending in some term insurance. But remember that only a handful of companies really do that well. So if I only have the ability to put in about 25% or maybe 50% paid up additions, I'm doing a disservice by offering that product when there's other products in the market today that will let me put up to 75% of paid up additions into the contract. That puts more cash value. Now, you squeeze out some other issues in the contract that we won't mention today, but it's doing the right thing for your client, especially if you're talking about cash accumulation.
When you think about it, the top contracts right now, I mean, are really huge. I mean, you're looking at Mass Mutual, you're looking at Ohio National, you have contracts that are Guardian. Some of these players are really good numbers. Now, when I compare this, I look at it and say, how low could I go on the S&P and match today's present dividend? By the way, a little heads up and kudos to Mass. They actually raised their 2012 dividend, and their numbers right now are #1 in almost every boilerplate that I've seen in every template we're using. So heads up on that. Think about it. Their numbers, what is that number in S&P? What would I have to hit? And most people are showing 7%. Sometimes they look back at 8%.
Right.
I only need 5.5% S&P return to match the #1 whole life. So you're going to compare when you're down in the conservative land and you're going to show that lower number in indexing. I might want to show a couple of these whole life as same and see which one you really feel comfortable with.
Right, exactly. Well, and interesting enough too, they say that the probability of 5.5% when you're talking about an index product is 100%.
Well, when you use the two 20-year tranches, kind of in a Monte Carlo-like model, those two 20-year tranches from point to point and on an annual basis, those numbers are 5.5, and he said 100% probability. I love odds like that. Well, when we come back from the break, we'll address variable UL and indexed UL used in life insurance retirement plans. And don't forget to enroll at IULUniversity.com for the best training, education, sales support when it comes to life insurance for retirement income.
You're listening to the insurance industry's #1 resource for products, planning ideas, carrier information, and interviews you can use. When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.
Everyone's looking forward to retirement, but how do you get there from here? You do it by paying yourself first every month and saving with Index Universal Life. And once you're there, how long is your retirement? With Index Universal Life, it can last a lifetime. How much can you keep? It lets you keep all of it. And what if you need it sooner than later? There's no penalty for early withdrawals, and you have the flexibility that you need. How to get started? Go out to www.iflplan.com and find out more and start looking forward for retirement. Well, welcome back to the Business Insurance Zone. I'm Steve Savant with Eric Palmer. And remember, you can order any of today's giveaway shows on thebiz at brokersalliance.com. And just a heads up, before moving forward with any of the ideas you hear on the show, always consult your tax advisor and your broker-dealer compliance officer. Hey, we're talking about in this segment VUL and IUL as insurance retirement plans. And of course, we're going to say the IUL for the coup de grace.
Right.
But variable, if I want to give one trumpet for variable, because there's kind of a comeback on this, and if they ever solve the preservation of principal issue, that could be a big deal.
Right.
But let's talk about it. I know so many clients that are still buying non-qualified mutual funds just as an irregular investor. When I went to the Thunderbird School of Global Management a couple years back, I noticed that the #1 seminar that all these people that flew in from all over the world, multi-millionaires that came in, they came to the place where they were looking at non-MEC variable universal life because of the tax wrapper. We're going to get into all this tomorrow on the tax issues. Variable universal life. If you're a mutual fund purchaser and you say, gee, Steve, I wouldn't mind having the tax advantages. I'm already going to do it. I want to be more than just doing the indexing.
Right.
I want to do something more in the equity market.
Right.
I say if you're doing non-qualified, and especially if you're into dollar cost averaging, to me, you should be looking at variable universal life as a dollar cost averaging proviso that you're doing non-qualified monies. So why not?
Well, if you're open to the risk, I think that's a great point. You know, if you're still going to put some money into, say, mutual funds, for example, then purchasing those fund accounts or those sub accounts inside of a variable life insurance contract might be a little bit more beneficial. So Both of those vehicles have some element of cost. So wouldn't you rather some of that cost go towards things like life insurance, tax-free loan capability, and flexibility? Let's think about this for a second. If I need to get access to my money before age 59 and a half, can I do that with anything other than a life insurance contract? You know, you have a lot of limitations to some of the alternatives that are out there. So even a VUL offers a lot of advantages over some of the alternatives that I would be investing my money in. So I have the ability to take advantages of being in the market. I get the upswings, but I also have some of those other little intrinsic values like the life insurance, the flexibility of withdrawal, and the ability to loan tax-free.
The moment I go into non-qualified investing with mutual funds, and there's a lot, I looked at some of the funds. We had one of our agents bring me a case. I looked and I found one of the growth funds that he's in love with, I found it on one of our VUL chassis, and I suggested to him, hey, this could be a play for you. The advantage is, and I told him this straight out, the expense loads on the VUL are going to be higher than your mutual fund.
Right.
But the countermeasure here, and then we'll get into indexing, the countermeasure issue is that I don't have tax issues if I do this right. And remember, last January, when your client got a statement from your non-qualified mutual fund and it was a loser fund, a week later, he got a 1099 for capital gains because of the interior trading that was going on.
Right.
And I've been in this thing 30 years, and it's so hard to tell a client, you have capital gains on a loser fund.
Exactly. It's tough.
So if you're looking for non-qualified, especially if you're dollar cost averaging into mutual funds and non-qualified scenario, you may want to look at VUL. Now, let's talk about indexing, because this is the hottest product in the United States, and especially why? Preservation of income. Talk a little bit about why we're so down on this. I'm not down on, I mean down in the hip way.
Yeah,
we're in the hip way. Sorry, we got a little hip on the zone.
Well, you know, index ULs are big. Since 2009, they've been growing by nearly 38 to 40% a year. So that's obviously a significant movement towards index ULs. And in fact, last year we hit the $1 billion in premium mark. So there's obviously a trend here with index universal life. And the biggest thing is that most consumers today, whether you're in your 20s, 30s, 40s, 50s, or you're just about to retire in your early 60s, you just experienced in the last 12 years some serious downturns in the market. You probably saw your 401ks take a tank. They're still probably trying to recover to some degree. And so the ability to talk to somebody about a 0% floor, forget the cost issue for a second, but the ability to participate somewhat in a market, but have that risk protection on the downside, it's a big deal. Then you add in all the other components that we talk about, the fees being competitive in a long-term structure, the tax issues that we'll talk about more in tomorrow's show. You really start to see a winner when it comes to an IUL. And again, we're not saying IULs or even life insurance are the end-all replacement for all your retirement, but it sure as heck should be the foundation of your retirement, because that's the part we can guarantee. We have to create a personal pension for people today. Pensions are less than 34% of the private sector. Most companies got away from pensions and went into 401ks. That started happening in the 80s. So everybody got on board and did a 401k just because they thought that that's all they really had the option to do. So index ULs have really become a foundation, and out of all the life insurance choices that we have, we really like them because we get best of both worlds. We get the ability to tie ourselves a little bit to the market, but not directly in it, so we have the downside risk. We have the ability to take advantage of all those life insurance components, and IULs are becoming more innovative. We're starting to see chronic and terminal illness benefits. Some companies are talking about bringing critical illness into these products. And even if that raised the cost of insurance a little bit, it's putting far more in terms of benefit on the table for your clients.
When you think about it, Eric's generation, Generation Y, these guys have been in the workplace about a decade. And they had 4 loser years in that decade. And I always think that I'm shy about the market being in my your almost retirement years, right? Heading for my retirement years. These young kids, their first 10 years in the business, they have out of the last 10 years, 4 loser years. My eldest son, which is just a little bit older than Eric, he came to me and said, Dad, what am I supposed to do? I got killed this decade.
Right.
They call it the lost decade. Indexing can mitigate some of these issues that we call, when we talk about it, calling it the lost decade.
Right.
So I always think about it, preservation principle is a baby boomer issue. Well, Eric, I'm asking you, you're a Gen Y-er.
Right.
Tell me.
Well, it's definitely something that's on our minds. You know, it's kind of one of those things where the theory was, well, because I'm young, I got enough years to be in the market and overcome my losses, but that's not the way I'm thinking. I'm thinking conservative. In fact, I took a lot of my 401k and I moved it into fixed funds during 2008. And I have a 401k, but I have a lot of money in my index universal life insurance product.
Well, if I'm thinking this way as a boomer, if he's thinking that way as a Gen Y-er, now we have a bigger, broader market to sell to. And remember, you can watch this show and all our shows by clicking the red on-demand video button right on our homepage at brokersalliance.com. Well, that's the Buzz on the Biz for today. Get in the zone, the business insurance zone.
The Biz is brought to you by Brokers Alliance, a national leader in insurance products, support services, and educational workshops. When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.